Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now, today's episode, we're talking about credit card credit limits. It's one of the more important topics I think gets skipped over in this game, but what exactly is a credit limit? How does it work? And what is everything you need to know to take full advantage of yours? So, of course, if that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. So when it comes to it, my whole tagline on the website is all the news you can use in the world of credit and finance. But what exactly is credit? Well, this is going to be another one of our 101 topics, because I do like to cover videos that I think get skipped over quite a bit. So as a result, if you need more, to get you started, you go to the main channel page. And of course, we have a full section right at the top there about 101 topics to get you started earning in the right way. So with that, though, what is credit limit? Well, very simply, we use a credit card, for example, because that's what we talk about here the most. A credit card is a credit product, and a credit product means that you have to qualify to get it, because what's happening is the issuer, the bank, is going to be lending you money when you make your purchases, versus something like a debit card, which is linked to a checking account where you can only spend how much money you have in the account. And as soon as you swipe the debit card, that money is debited from your checking account. Not necessarily immediately, they'll put a hold on it or something, but it's going to be removed from your account very shortly. Credit card, on the other hand, you're not really using your money. You're using the bank's money. They're lending you money when you make a purchase. So as a result, to get a credit card, there's going to be a credit check, which is a credit inquiry. It shows up on your credit report. You'll usually get some kind of notification from Experian, TransUnion, or Equifax, the main three credit agencies, that someone's used your credit. So, especially if you have credit monitoring set up. And what the bank's doing behind the scenes is running your credit information, your income, things like that. They ask you at application, which would be the big ones, income and then your credit, through their decisioning models, figuring out if you're credit worthy in their opinion and how much money they're willing to lend you. So let's go down the path of you got approved for a card. We like the happy path. So let's say you get approved for a regular credit card. We'll call it the Citi Double Cash, if you will. So a credit card is basically a revolving line of credit, which means you're going to get a few terminology things here. So you're going to have a credit limit. Let's just make it easy. Let's say your credit limit is $1,000 on this Citi Double Cash card. So that means you could, at any one time, you could spend up to $1,000 on this credit card. It can be over multiple purchases, one purchase, what have you. You can spend $1,000. And that's basically the bank saying, we will lend you $1,000 for this statement cycle. Statement cycle is basically 3 to 4 weeks long, and so during that time you're making purchases, the bank is keeping track of all of them. At the end of that statement cycle, you'll have a statement closing date, and they will send you a bill, and then you have 3 weeks to pay that. That's known as the grace period, because back in the day, they actually had to mail you a bill, and then you had to write a check on the coupon that they give you and then mail it back to them, and it would take about 3 weeks to do that. So that's why you have that grace period, give you plenty of time to pay. And as long as you pay that off in full, then there is no interest charged to your account. Of course, if you don't pay it off in full, then they're going to bring all that interest due and start charging you interest as you go, right? So we always want to pay it off in full, because interest rates on credit cards are very high, and we'll talk about why. So that's the cliff notes of how it works. But if we go back to our card example here, the double cash, so you have $1,000 of available, or $1,000 credit limit. You make a $100 purchase. So now you're going to have a charge for $100 on that credit card. You're going to owe Citi, in this case, $100. So your total credit limit, your credit limit will still be $1,000, but you have a new term in here called available credit limit. So the credit limit you now have available to spend is only $900. Because we're subtracting that $100 that we already owe from the credit limit that we had. So now you can, if you pay that back, you pay that $100 back, your credit limit is still $1,000, but your available credit also goes up to $1,000 to match it. So they call this a revolving line of credit, because the line just keeps revolving as you use it. You use it, spend it down, pay it off, it goes back up, versus something like a mortgage is a fixed, right? So you borrow $100,000 to buy a house. That's why it's part of the reason they call it a 15-year fixed, a 30-year fixed. It means your payment is fixed in that principal. You're not going to borrow any more principal as a part of that loan. Now, yes, your loan, your payment can change due to taxes and stuff, but we get the point. It's fixed, right? Your credit card payment will always be a little bit different, because sometimes you spend more, spend less, what have you, and the credit limit goes back up. When you pay off your car, when you pay off your mortgage, that loan is closed, and you own that asset outright. So that's why we call it a revolving line of credit. Now, another thing to keep in mind, we talked about avoiding interest on these credit cards because interest rates are very high on credit cards, and that's because it's a form of what they call unsecured debt. So if we go back to our auto loan or our home loan, those are secured debt because if you don't pay, there's still an asset that the bank can take back. Despite popular opinion, they really don't want to repossess your stuff. It's actually a lot of work and a lot of hassle. They have to find someone to maintain it and sell it, that whole thing. So they really don't want to, but it's still a way for them to recover some of their money. In addition to that, when you're buying a home, they usually require you to at least put something down. There's also other insurances in place like mortgage insurance that you're forced to pay a little bit on in case each month in case you default until you get to, having 20% equity. But with a credit card being unsecured, it means if you buy a sandwich for lunch, and you don't pay the bill, no one's coming back to get the sandwich from you, right? The bank's just out of money, so they basically compensate for that by pricing in risk with higher interest rates. So just something to be aware of. That's why you always want to avoid credit card interest at all costs, because it always is much worse than any rewards you're going to earn. So high level, that is how credit product works. Now the benefits here, because again, you could be looking at this and like, well, why would I do this? You just said the interest rates are terrible. Well, the benefits, there are a few things. So the first benefit is probably isn't talked about enough is simply building credit. And it's kind of a cliche chicken or egg thing. To get a credit card, you have to have credit. But how do you get credit? Well, the easiest way to get credit is actually a credit card, because when you're 18 is when you can start getting cards of your own. No one's giving you a car loan. No one's giving you a mortgage. No one's giving you anything like that. So a credit card is actually the easiest way to go. You could be added as an authorized user to one of your parents' cards or family members' cards. That kind of jumpstarts your credit, takes their credit card, kind of reports it onto your report as if that history was your own. But at 18, 19, if you're a student, you can get a student credit card. The bank's going to give you a very low limit, but that's fine because at this stage in the game, it's really about building credit. So we put up our FICO wheel here, even if you got a $500 credit limit, that's fine. But you can see the major factors of credit score are going to be, average age, which, you're trying to build that up. You need credit history, payments, right? You need to make on-time payments. So, of course, by, using your card and making on-time payments, that will happen automatically. Then, of course, utilization or how much you owe is, making sure you don't owe a ton of money on credit cards, because that makes you look pretty risky that you have all this outstanding debt, right? There's old numbers there, but really, I say with credit cards, you just want to keep that utilization as low as possible because you don't want to carry a balance. There's no issue letting the statement close in that balance report, but you just want to have it paid off the end of those 3 weeks in full. So I don't think there's really a ton of value in going through like, hey, what's the actual utilization I should be aiming for? The formula, though, really quick is just, the way to bring down the utilization is, of course, paying it off. But, of course, the more available credits you have, the denominator, however much money you owe, it just ends up being a smaller percentage by how math works. So there is that. So, more credit cards is actually pretty good. Do you have to go crazy like we do here and get 15 or 20? No, but, having a few definitely helps get you jump-started in the credit game. Once you've been making on-time payments for about a year, I would say, you should be good to go, to start branching out further into other credit cards if you want, or, at least be able to get your own car loan, maybe without a cosigner or something like that. So it's a great way to get that started. In addition to it, there's the rewards, which we cover extensively on this channel. There's the purchase protections, the benefits that credit cards give you that debit cards don't. Again, we have videos for that as well. So when you bring it all together, again, these aren't necessarily related to our core topic of what a credit limit is, but these are the ancillary benefits of it. And, credit limit really ties into the credit card product. There are other products like home equity lines, and you can have revolving personal lines and things like that, warehouse lines. But the one that people are going to encounter most is a credit card revolving line of credit. So overall, that is how credit limit works. It's actually very simple and easy to understand. Again, just make sure you make those payments. Really easy trick is to set up automatic payments, at least for the minimum. That way you won't miss a payment. Missing a payment would be worse than, taking on the interest, for example. So set those up and get in good habits, and you should be good to go. So, of course, if you want more one-on-one stuff to build on this, the full main channel page has everything you should need. If there isn't something or you're missing something, by all means, let me know. We'll be happy to get that recorded for you so you have all the knowledge you need to know to take full advantage of this game of credit and finance. But anyways, guys, that's going to do it for this one. So, of course, if you liked it, drop me a thumbs up down below. If you found it particularly interesting, consider subscribing to the channel because we're posting content just like this every single week. Of course, right back every Sunday with all the news you can use in the week that was in credit and finance, and every single day over on profitablecontent.com, where we have the latest bank bonuses, card offers, and news stories. Again, love to get your thoughts on this one. What other one-on-one topics would you like to see covered here? But anyways, guys, thanks so much for watching. I'll talk to you very soon in the next one.